The reporting requirements for small and medium-sized entities, SMEs, were developed to provide a simplified and practical financial reporting framework suitable for entities that do not have public accountability. Full IFRS accounting standards are often highly detailed and complex, making them difficult and costly for SMEs to apply effectively. The IFRS for SMEs accounting standard was therefore introduced to balance transparency and comparability with cost efficiency and practicality. SMEs typically have fewer resources, simpler transactions, and fewer external reporting obligations compared with publicly accountable entities. The objective of SME reporting standards is to provide useful financial information for owners, lenders, creditors, and other stakeholders while reducing unnecessary compliance burdens. This approach supports financial reporting accessibility and promotes consistent accounting practices globally. Several principal considerations influence the development of financial reporting standards for SMEs. One important consideration is cost-benefit balance, ensuring that the benefits of financial reporting justify the costs and administrative burdens imposed on smaller entities. SME standards must also focus on the information needs of primary users, who are typically lenders, suppliers, owners, and tax authorities rather than public investors. Simplicity and understandability are essential because SMEs often lack specialized accounting expertise and advanced financial reporting systems. In addition, SME standards should maintain sufficient consistency with full IFRS accounting standards to support comparability and facilitate future transition if entities grow or become publicly accountable. These considerations help create a reporting framework that is practical, reliable, and internationally relevant for smaller organizations. Differential financial reporting refers to the concept that different types of entities require different levels of reporting complexity and disclosure. Applying identical reporting requirements to both multinational corporations and small private businesses may create unnecessary burdens for SMEs without improving the usefulness of financial statements significantly. One solution to differential reporting is the development of a separate IFRS for SMEs framework containing simplified recognition, measurement, presentation, and disclosure requirements. Another solution involves reducing disclosure requirements while retaining core accounting principles. Some jurisdictions also permit tiered reporting systems, allowing entities to choose reporting frameworks based on size, public accountability, or stakeholder needs. These approaches improve flexibility while preserving comparability, reliability, and transparency within financial reporting systems. The IFRS for SMEs accounting standard simplifies many accounting treatments compared with full IFRS accounting standards. Simplifications include reduced disclosure requirements, simplified measurement methods, fewer accounting policy options, and elimination of topics considered irrelevant to SMEs. For example, SME standards generally simplify accounting for financial instruments, goodwill, borrowing costs, and income taxes. The reporting framework also uses clearer language and shorter guidance to improve accessibility and practical application. These simplifications reduce implementation costs and administrative complexity while still providing meaningful financial information to users. By focusing on common SME transactions and reducing technical requirements, the standard supports consistent financial reporting without imposing excessive compliance obligations on smaller entities with limited accounting resources. Certain topics included in full IFRS accounting standards are excluded from the IFRS for SMEs accounting standard because they are either too complex, rarely encountered by SMEs, or not relevant to typical SME operations. Examples may include earnings per share, interim financial reporting, segment reporting, insurance contracts, and highly sophisticated financial instrument accounting. Excluding these topics helps reduce complexity and implementation costs while maintaining focus on areas most relevant to SME stakeholders. In some cases, omitted topics are replaced with simplified alternatives or references to full IFRS guidance when necessary. This selective approach ensures that SME financial reporting remains practical and proportionate to the size, operational nature, and informational needs associated with smaller privately accountable entities. Overall, the IFRS for SMEs accounting standard provides a practical and internationally recognized framework tailored to the needs of small and medium-sized entities. By simplifying recognition, measurement, disclosure, and presentation requirements, the framework balances transparency and comparability with the operational realities faced by smaller organizations. Differential financial reporting solutions acknowledge that SMEs differ significantly from publicly accountable entities in complexity, stakeholder expectations, and reporting capacity. Excluding highly specialized or irrelevant topics further improves usability and reduces compliance burdens. For DIP IFR candidates, Understanding SME reporting requirements is important because SMEs represent a substantial portion of global business activity and require financial reporting standards that support accountability, decision-making, financing access, and sustainable growth within diverse economic environments.